Book 3, Chapter 2, Insurance Companies and Pension Plans. We're going to cover this chapter in 3 videos. The first video is going to cover mortality tables, life insurance, and pension plans. The second one is going to cover property and casualty insurance and health insurance. And the last video is going to cover moral hazard and adverse selection and regulation. Let's get started. So here's the introduction to the whole chapter. Insurance companies, what do? They protect policyholders against specific adverse events in exchange for periodic premium payments. For example, if we talk about life insurance companies, they protect the policyholders against what specific adverse events? In the case of their death. They will get, or their beneficiaries will get, a large lump sum of money. And why will the insurance company pay this? Because the policyholders pays periodic premiums. You have 3 categories of insurance companies. One we just discussed, the life insurance, and this is going to be discussed in a lot of detail in this video. And then the other 2, which is property and casualty insurance and health insurance, will be discussed in the next video. Also, what we're going to talk about in this video are pension plans, and we will be talking about 2 different types of pension plans. One is the defined benefit pension plan and the other one is the defined contribution pension plan. In the defined benefit pension plan, the benefit to the pension beneficiaries, which are the employees of a company, is defined. The benefit is defined in the sense that, okay, you will get your last salary until you're alive. And in a defined contribution plan, the contribution that the company makes towards the pension fund is defined, and then how much that will be depends on how it is invested, and the employees then choose how they want to invest their particular pension. So we will be talking about the similarities between pension plans and life insurance in this video as well. But first we need to understand what are mortality tables, because whether it is pension or life insurance, it all depends on how long somebody is expected to live, and that is a matter of probability, and this science is called actuarial science, and the people who are experts at this are called actuaries. So let me introduce you to a mortality table. This looks quite confusing, but it's actually very simple. So this is an extract from a mortality table from the US Social Security Administration from 2016. And first of all, it's just for males and females, right? So half of that table is already making sense to you, because it's not this huge thing. It is just repeated twice. One side is males and the other side is females. And then within one side, it's just that you've got age going up, and then the probability of surviving to that age is going down. So here you can see there's a 97.2% chance that somebody, a male, can live to be a 30-year-old, and that goes down all the way to almost 10% chance of somebody getting to be 93 if he is a male. As you can see, it is a much higher chance of getting to be 93 if you're a female, which is approximately 18.54%. And the other 2 columns here are life expectancy, expected how many more years you will live. So if you're 30 and a male, so it's expected that you will have another 47 years of life beyond that. And if you're a female at 30, then you can be having approximately 52 years. And what is the probability that you die specifically at that age within the year? Is less than 1%. It's 0.1794%, because this is in decimal. So 1% would be 0.01, and this is less than 0.01. It is 0.001794, which means 0.1794%. This is the probability of a male dying before turning 31 at the age of 30. Now, how does all of this apply to the business of life insurance, and what are the different types of life insurance? So, we're going to be looking at a lot of different parts of this life insurance business one by one, starting with the whole life insurance. Now, whole life insurance is for the entire life, right? Which means until that person, he or she, dies. Now, until you die, you keep making these payments, and 100% for sure you are going to get a huge lump sum, or your beneficiary, obviously, since that the policyholder will be dead, the beneficiary will receive amount up to the face value of the policy upon the death of the policyholder. So the payment is certain, but the timing of the payment is what is not certain, because this depends on the life of the policyholder. As long as the policyholder is alive, they have to make the payments. But the good thing is that the payment is certain on death. So from an insurance company's perspective, what does this look like from a business perspective, right? So let's say there is a policyholder who is going for a 1 million policy, which means the insurance company will have to pay out $1 million if the policyholder passes away. And let's say we're talking about a 30-year-old male, and the age of 30 is when the policy is being signed. So now we're going to look at what happens over the next 1 year, 2 years, 5 years, 10 years, 40 years. And every year, the insurance company is getting $15,000 from this gentleman. And let's see what happens in the first year. So let's look at the first year now. And we know from this chart, so this is an extract from the big chart that I showed you. And I'll be following this methodology in the next few slides as well, that because just to save space, I have not re-shown the chart again and again. I've just shown the extract from that chart, which is relevant for our question on the screen. So here we're talking about the first year, and since the first year is when this gentleman is 30 years old, so we are concerned with this row from that chart and these columns from that chart, since it's a male and he is 30 years old. So the probability of this person passing away right now before turning 31 is less than 1%. So specifically 0.001794. And if you multiply that probability with the 1 million amount, so this is what you get as the expected value. And you might remember this from book 2, that the expected value is calculated by multiplying the probability with the amount. So if we are talking in terms of expected value, the expected payout in the first year of the policy, this is the first year of the policy, is $1,794. And if you compare it with the money that the company, the insurance business, will be getting from this person, is $15,000. So this is good business, right? At least in the first year, it's good business from the insurance company's perspective, because you're getting $15,000 and you might have to pay out $1,794. And I know that sounds a bit weird, because if you have to pay out, you're going to have to pay out $1 million. But we're not thinking about it in terms of $1 million. We're thinking about it in terms of probability, because we don't know if this person will pass away this year, right? There's only a less than 1% chance. It's a 0.1794% chance that he's going to pass away this year. So we're taking that probability into account and then taking our decision. Now, if you see what happens in the second year, is that there is a probability of 0.1832% or 0.001832. Now, how did we get to this figure? First of all, we said this person is surviving in the first year. So instead of taking the probability of this person dying in the first year, what we're basically taking is 1 minus that. Right, 1 minus that, and that basically gives us the probability that he survives the first year, and then we multiply it with the person dying in the second year. So it gives us the joint probability that he survives the first year and then dies in the second year, which is multiplied by 1 million is giving you the expected payout for the second year, 1832. Now let's just stop and pause here for 1 second, and I want to bring in this second column and how all of this ties in. So one way of calculating the probability of this person dying in the 31st year is you take the probability of dying in the 30th year, 1 minus that, and then multiply with the 31st year. Or this amount you can also get, which is 1 minus the 30th year probability, you can also get using the survival probability as well. So this will be the same as survival probability of 31st year, which is 0.97063 divided by 0.97238. So this will also give you the same answer as 1 minus 0.001794. So that works as well, and then we will be using this approach because the first approach, which you see over here, can get quite cumbersome because you have to do the calculation again and again. And let me show you how that would be if we do it for the third year. Now, if we are saying, okay, this gentleman has not died in the 30th year, not died in the 31st year, but what is the probability that he might die at the age of 32? So first we will have to say, okay, didn't die at 30, so 1 minus the probability of dying at 30. Didn't die at 31, so multiplied by 1 minus the probability of dying at 31, and then multiplied by the probability of dying at 32 will give you specifically the probability of this person dying at 32, and then if you multiply that with the $1 million payout, you get the expected value of 1873. Now these steps can get very cumbersome if we have to do it for, let's say, the 10th year or the 15th year. So that is where this second method comes in very handy, and let me show you for the 41st year. So let's say now we want to find out, okay, what is the probability for the 41st year that what is the probability that this person will pass away in the 41st year of the life insurance policy, which means he's going to be 70 years old by then, right? Because he's getting the policy at 30, and 41 years later he's going to be 70. So the first question is, instead of taking 30 year when 1 minus that and then multiplying with 1 minus the 31 year and then 1 minus the 32 year, what we can just do is that the probability of this person surviving up to 70 from 30 can be calculated by taking the survival probability of 70 and divide it by the survival probability of 30, and that will give you the probability that this person hasn't died till he has reached the age of 70. But then in the 41st year, when he is hitting 71, what is the probability that this person will die? And that is given from this number over here. So when you multiply these two, you get the probability that this person will die at the age of 70, and multiply that probability with $1 million payout, you get the amount expected value of 17,321. And notice how this is now greater, or 17,321 is greater than the $15,000 premium this person is paying us. So initially, and let me just go back one slide. Initially, we had a payout of, let me just go back one more slide. So in the first year, we had a payout of 1,794 expected, much less than the $15,000 that he is paying us. So that's good for us, right? And then second year also 1,832, which is much less than 15,000, and 1,873, much less than 15,000. But then as the policy grows and goes older, this person's probability of dying is going up, and since that is happening, the expected payout is going up, and we as an insurance company are getting scared. So I mean, if you look at the comparison which is shown over here, in the first year we're having a positive amount coming to us, probably speaking in probabilistic terms, of obviously, that there's a very low probability of this person dying, and he's giving us this 15,000. So that's good for us. Still low, still 15,000. So this is also good for us. But then look at what's happening in the 45th year, 41st year of the policy. We're actually going into a deficit over here. So this expected deficit has to be offset with the surplus in the early years. And if you look at it in terms of a figure, in terms of a graph, this is what it looks like, that the money coming to us is flat at 15,000 every year. Initially we have this surplus, later we have this deficit, and if this policy holder lives beyond 70, then it's not going to be good for us. It's from a business perspective, right? But then not everybody is going to live beyond 70. So this is it's a averages game from the insurance company's perspective. And naturally, of course, the insurance company will be charging a higher premium. So this 15,000 is not just going to be enough to cover the expected deficit later. It will be a little bit more than that, so that there is a profit in it for the insurance company. Now, how does the insurance company calculate the amount of premium this person has to pay? So where does this 15,000 come from? Now this 15,000 actually has two components. One of the components is the cover, which means this is the amount of money that this person is paying to get the risk cover. So for the risk cover, which is that 1 million that we were talking about, right? And the second part is a savings portion. That you can think of it in terms of extra money the policy holder is giving, which they will get back, right? And they can even choose how they want to invest this extra money. So if you have a variable life insurance, then the policy holder can specify how the surplus funds are to be invested. And then obviously if the performance of the funds is very good, then the final payout will also be very good. So the final payout depends on the performance of the fund. Let's say we don't want this savings component to be a lot, right? So we say, okay, so how much are you taking for us from the cover perspective? Let's say 5,000, and the 10,000 is the surplus amount. So let's say we don't want to pay 15,000. We want you to reduce the saving amount and make the premium 10,000. In that case, what you have is something called a universal life insurance, where the policyholder can reduce the premium down to a specified minimum. And then obviously the final payout will be lower as well. Then the insurance company will say, okay, we cannot give you 1 million, we'll give you 800,000 or something like this. And the second thing which is important, which is not written over here, is that this 5,000, the surplus, is not invested in any kind of stocks or any kind of risky investments. This is usually kept as cash. So therefore the return is also going to be lower for this. But another point which is not written over here, which I will tell you, is that the policy holder is allowed to borrow against this cash. So they can use this as a collateral, and you can then borrow against this cash, because this is hard cash, right? It's as good as hard cash against it. Alright, now moving on to the second type of life insurance, which is term life insurance. This obviously is not whole life, so you don't get a guaranteed payment here. So this is for a specified number of years, usually up to maybe like 70 years of age or 75 years of age. And then if you die before that, so if the policyholder dies during this period, then their beneficiary receives a huge payout, or whatever is the face value of the policy. Otherwise there will be no payout. So here there is no guaranteed payout, but naturally the premium will be less over here compared to a whole life. So again, mortality tables can be used to calculate the break-even premiums, and I will show you with an example how that is done. And what we are going to do in that example is we're going to equate the present value of the expected payouts to the present value of the expected premiums. Now before we move on to the example, I just want to explain this statement, because it is a complicated example, and it's important that we understand it correctly. So on one side, we're going to equate, that's why I've drawn this equal to sign in the middle, the present value of the expected payouts. So present value of expected payouts to the present value of expected premiums. Now notice how there's the word expected on both sides, which means we're going to have to use probabilities, right? And notice how there is the word present value on both sides, which means we're going to have to do discounting. Now, you have hopefully done your book 2, so a lot of the multiplication with the probabilities and a lot of the discounting for the present values is covered in book 2, so you need to have those concepts, and it's then it's going to look like a fairly simple calculation for you. The concept that I'm trying to explain over here is that on one side we're going to calculate what will be the present value of the expected payouts depending on the mortality table, right? So you're going to use the mortality table to calculate what is the probability this person will die at a certain age, and for that given term insurance, that okay, we are writing that policy till this certain age, so we will calculate the present value expected payout, and then we'll try and figure out, okay, how much premium will be the break even premium, which is going to equal to this amount of expected payout. And then we'll obviously not just take this premium. As an insurance company, you of course will charge more than that because you want to make a profit, but at least first we'll calculate the break even amount, and then we'll know how much more to what's the minimum we need to charge. Right, so now let's get into the example. It's a long example, so brace yourself, and this is obviously coming from your curriculum. This is question number 12 from your curriculum. So what is the break-even premium or the minimum USD annual premium that you should charge for a 2-year? So very simple, it's just a 2-year term life insurance policy with a face value of 1 million for a woman who is age 71. So naturally you're going to take the female section from the mortality table, and since she's already 71 and we're talking about a 2-year term life only, so we are only concerned if she passes away over the next 2 years. Now what I will do is, I've got the solution on the next slide, so I will take it to the next slide, and then I'll keep coming back to this slide just to show you where the numbers are coming from this table, right? So let's go to the next slide. So here, let's understand this step by step. The first thing we are having an assumption is that the person, if we are saying she's passing away in the 71st year, or she's passing away at the age of 71 or at the age of 72, what we're basically saying is that happens during the year, in the middle of the year. So the time we'll be taking is 0.5. And why that's important is because you'll see that when we are going to be discounting, it is going to be for half a year or 1.5 year. That is why this 0.5 is important. Now, first of all, where are these numbers coming from? This 0.017089, so please stay with me, I'm just going back to the previous slide. Now here you can see the probability of her passing away at the age of 71 is 0.017089, which means if there is a 1 million payout, that has an expected value of 0.017089 multiplied by 1 million, which is going to be $17,089, right? This is for the first year of the policy, or 71 years of age for the woman. Now for the second year, obviously it's going to be different, because first we will have to do 1 minus 0.017089 to calculate the probability that she survives that year, and then multiply it with 0.018861, and then this will be multiplied by 1 million. And let me just take you to the next slide, and that is what you see happening over here, right? So this is the amount, the expected value of 0.018539, which you multiply with 1 million. So let me just go back and write over here. So this will come to 18539 So and then let me just go back one more slide. So when we're talking about the present value of expected payouts, Now we've already calculated the expected payouts. For the first year it's that 17,000 amount, and the second year it's that 18,000 amount, but we need to calculate the present value of the expected payouts, which means we need to discount them back, because if this payout happens, it will be half a year from now, and if this payout happens, it will be 1.5 years from now. And that is what you see happening over here, is that the 17,000 is discounted back for half a year, and the 18,539 is discounted back for 1.5 year. And this dollar amount of 34,573 is basically the right side of your equation, which is the present value of the expected payout. So the present value of the expected payout is 34,573. Now we're going to move to the left side of the equation, which is the expected value of the premium that we need to calculate, the break-even premium that we need to calculate. So again, for the first year, how much is it going to be? That is going to be X. And for the second year, again, this is expected value, so the premium will only be paid in the second year if this person survives the first year. So what is the probability of surviving the first year? It is 1 minus 0.017089 or 0.98291. So if we multiply that 0.98291 with X, because the premium for the first year is of course guaranteed, since she has to pay the first year premium, right? But the probability of receiving the second year depends on her surviving the first year. So the probability of receiving the second year premium depends on her surviving the first year. Therefore, we are multiplying it with this probability. And since it's the present value of the expected premium, therefore we will have to discount it back. Now we don't need to discount the first one because that is being paid to us right now. The second one, of course, we have to discount for 1 whole year. And of course, when something doesn't have a coefficient, the coefficient is 1. So if you will actually calculate this 0.982911 and you divide it by 1.03, what you get is 0.954, and the 1 plus the 0.954 is basically going to give you 1 plus 954,283x. And we already know the right side of the equation, which is the present value of the expected payout. So if you equate the present value of the expected premium with the present value of the expected payout, and then you solve for X, you get that your break-even premium is $17,691. Naturally, you should charge more than that to cover your cost and of course make a profit. Now, the third type of life insurance that we're going to talk about is endowment. Now, this also has a guaranteed payout. So if the policyholder dies during the policy, the payout is made at the time of death. Otherwise, what happens is that you can get your money back. So there are two variations of endowment life insurance. One is with profits, which means the final payout can increase if the investments that you have done, that the insurance company has done on the policyholder's behalf, do very well. And that obviously there is a certain amount of uncertainty involved with that. What the investor or the policyholder can also do is just ask for a unit-linked endowment policy, where the policyholder will just choose a fund, and then based on the unit value, the net asset value of that fund, the payout will be linked to the performance of that fund. Now, companies can get life insurance for their employees, and some companies have thousands of employees, tens of thousands, even sometimes hundreds of thousands. So what happens is that medical tests are usually not required for this. Why? Because from the insurance company's perspective, they know they're insuring a large pool of people, and some of them will be expected to live long, some of them will be expected to live short. So the insurance companies knows that they are taking on some good risks and some bad risks, so they are happy with this kind of a group life insurance. Now, what is the opposite of life insurance? That is called annuity contract. So in a life insurance, what you are basically doing as a policyholder, you're paying a lot of small payments, and then you're getting this big balloon payment from the insurance company. Annuity contracts are the opposite, where the policyholder first pays a big balloon payment to the life insurance company, and then the life insurance company keeps paying small amounts to the policyholder for the rest of their lives, right? You can buy the annuity and it will begin immediately. So upon retirement, you can buy the annuity and you will keep getting this money until you're alive. Or what you can do is buy it earlier as well, and then it won't start making the payments until later, and this is known as a deferred annuity. And some deferred annuities even guarantee a certain level of minimum payments. If for instance you're worried that you're not going to live that long and your annuity is already starting so much later, so then they will at least give you a certain level of minimum payments, and if you're not around, then to your beneficiary. So you can also have your lump sum being invested and growing while your contract is there, and this can be referred to as the accumulation value. If you want to withdraw your funds early, that is possible, but there will be a certain penalty for that. Now, from the insurance company's perspective, what are the risks over here? Number one, with life insurance, the risk is with annuity, the risk is that somebody lives longer than expected. So since we have to, as insurance companies, we have to keep paying them until they're alive, and if they are living for too long because of advances in medical science and improved nutrition and other factors, then we will be stuck paying them for a very long time, right? So this is definitely bad for the annuity business. But longevity risk is good for the insurance business, because then if they're not dying and they're just paying us premiums, then we don't have to pay until a much later period, right? So that's good for us from a life insurance perspective. Now, the mortality risk is related to somebody dying early. Now, people die earlier, maybe due to wars or epidemics or pandemics or whatever, right? But this is good for the annuity business, because then you don't have to pay them anymore. But this is bad for the life insurance business, because then you have to pay this huge lump sum very early, and you haven't actually received that many premiums. So you don't want people dying before 70, because that's when you get a lot of premiums and you're still having a positive situation until then. So you don't actually want them to live too long. You don't want them to die too early either. I mean, just as per the statistics would be nice. Anyhow, so if an insurance company offers both life insurance and annuity products, then what you could do is you could offset each other, right? And that's very good, but the problem is that it's not so easy to do, because you will not be able to sell exactly the same amount of products on both sides. So what do we do for that? How do we manage that? So there are some derivatives that you can use. They are called longevity derivatives, and there will be a certain pre-specified mortality rate based on the statistics that we have, based on for example, the table that I just showed you, and then there will be a realized mortality rate. Maybe people have died earlier or later, and whatever is that difference, right? If it's lower, then that's good for you. If it's higher, then that's bad for you. Then if it's lower, you'll get a certain payoff. Another option is to get into a longevity bond, and that has either its principal or its coupon linked to the same difference that we talked about, which is the pre-specified mortality rate minus the actual mortality rate, right? So since we have that exposure and we have to manage that residual exposure, so you can use derivatives to manage this residual exposure, or you can use longevity bonds to do it. Of course, you can use the surplus funds to make very good investments, and if you do that, then you will be able to actually have that surplus income help you out. What usually insurance companies do is they invest in long-term corporate bonds. Now, these are not government bonds, these are corporate bonds. So not only are they subject to interest rate risk, which is a type of market risk, but they are also subject to default risk or credit risk if the corporation goes bankrupt and is not able to pay. Now, that is very dangerous, but you could, to avoid credit risk, you could invest in government bonds, but it's not good because the rate is low on government bonds. So, is the credit risk worth it? The answer is yes. Over the long term, what we have seen is the extra returns offered by the corporate bonds actually more than compensate for the losses arising from defaults. But obviously, you have to choose your bonds very carefully. Now, that is it for life insurance. Let's talk about pension funds and then close this video because it's getting quite long. Pension funds are two types. Either it can be a defined contribution or a defined benefit, as we talked about earlier. So, what happens is the company is obviously doing this pension plan for their employees, and they are like contracts between the company and the employee for after their retirement. And if you have a defined benefit plan, which means the employer is taking a big risk here because they are guaranteeing a certain amount of pension for their employees. Now they are responsible for making sure they are able to pay it, right? And usually there's a formula for it. So, for example, average annual income during last 3 years multiplied by number of years of employment multiplied by 2%. And now I know you must be thinking 2% is so less, but if the years of employment is 50, so after 50 years of service multiplied by 2%, so naturally this person is going to be getting their last salary of the average 3 years last salary for the rest of their life. So higher the number of years of service, the more the pension amount will be. And this 2% is not fixed, it can be different, depends on the company policy. Now, for a defined contribution plan, it's completely different. And this is a very safe option for the company, from the company's perspective, because they are not taking the responsibility of the benefit. They are not defining the benefit. It's not a defined benefit plan. It's a defined contribution plan. And what that means is that the amount of money the company has to put into that box called the pension fund is defined, and that is the only responsibility that the company has. Now it's the employee's responsibility to choose how they want to invest that money, right? They can go for a conservative investment option, a moderate or an aggressive one, and then naturally the risk and return is something you should have a pretty decent idea about now, that higher the risk, higher the return, but then it's not always the case that the return is there. So it depends on performance, right? So the final corpus amount will depend on how the chosen funds have performed. And at retirement, the employee can either take this whole amount and withdraw it, or they can convert it into an annuity and see how much regular payments they can get against it on an ongoing basis. So naturally, in a defined contribution plan, the employee is bearing the risk, right? But in a defined benefit plan, it's the employer or the company which is bearing the risk. Now, how do we go about doing this? So again, the company has to hire actuaries who use actuarial science to calculate the present value of the pension obligation, which is usually done based on like how many employees you have, what is the age of those employees, how much are they expected to live till, and what is the pension of each employee. And then you calculate, okay, what will be the obligation or the liability from the company's perspective, and then they see, okay, how much assets the company has in their pension. And will they be able to actually pay this liability? And if not, if there is a shortfall, then the company has to make up for this shortfall. And so what I've seen practically happening is that if there is a shortfall, this will show up on the liability side of a company's balance sheet, which is a pension liability. And if they actually have extra assets or surplus assets, then it will show up on the asset side as pension assets. And from year to year, it changes. Sometimes the assets are more and sometimes the liability is more, because of course markets go up and down and the assets go up and down with it. This computation of the liability part, by the way, it's very, very sensitive to the discount rate used. And now accounting standards actually require that we use the yield on AAA bonds to discount back these liabilities. Also, one important point is that if you have a defined benefit plan, all the contributions are pooled together and managed together. But if you have a defined contribution plan with each employee choosing either a moderate or high level of risk or aggressive level of investment, then obviously they will have different accounts. So in a defined contribution plan, what you have is separate accounts are maintained for each employee.